Bed Bath & Beyond investors got a jolt Wednesday. Its shares jumped by more than half at the market open as retail investors piled into the stock. Sparking interest in the shares, the retailer said Tuesday it'll speed up its share buyback program and it'll team up with supermarket operator Kroger to bring its line of home and baby products to the grocer's website. The sudden rally in Bed Bath shares reignited interest in other heavily shorted so-called meme stocks that are popular among the Reddit message board crowd, such as GameStop and AMC Entertainment, but are shunned by Wall Street professionals. So-called short sellers make money when the stock that they bet against declines. The surge in Bed Bath shares makes them ripe for a squeeze, whereby investors betting against a company are forced to unwind their exposure to curb losses. Many short sellers lost billions of dollars earlier this year when retail investors fueled eye-popping rallies in certain popular meme stocks. AMC shares are up more than 1,900% this year, GameStop more than 1,100%, despite the bets big investors had placed against them.
The cloud is ubiquitous. I don't know whether the metaverse will be equally ubiquitous, but at this point, I think what really matters is that we focus on making it useful and helpful for people in their lives. The one thing we cannot do is just move forward to the metaverse without cleaning up the problems that exist on the internet today and without learning the lessons from that work to build a metaverse that is safer, more secure, more private, more respectful even of humanity's needs. I think right now we're all talking about the metaverse as if we're entering some new dimension. This is not like dying and going to heaven. We're all going to be living in the real world with people. I think it's important that we use the hype to build enthusiasm where enthusiasm is appropriate, but we not let the hype obscure that these are all parts of long-term technology trends. What you're going to see is there's Facebook's version of the metaverse. There's Microsoft's version of the metaverse. There will be Apple's version of the metaverse. There will be Google's version of the metaverse. Everyone is going to be entering this.
Today, the FOMC kept interest rates near zero, and in light of the progress the economy has made toward our goals, decided to begin reducing the pace of asset purchases.
The Federal Reserve took the first steps Wednesday to reducing the massive help it's been providing the economy ever since the health crisis knocked millions of Americans out of work last year. Fed Chief Jerome Powell announced the Fed will reduce its $120 billion monthly bond buying program by $15 billion each month, beginning sometime in November, but left the door open to speed that up if inflation continues to run hot. The central bank took notice of the biggest price surge in decades and the impact that's having on everyday Americans.
We understand the difficulties that high inflation poses for individuals and families, particularly those with limited means to absorb higher prices for essentials such as food and transportation. Our tools cannot ease supply constraints. Like most forecasters, we continue to believe that our dynamic economy will adjust to the supply and demand imbalances, and that as it does, inflation will decline to levels much closer to our 2% longer run goal.
Central banks like the Fed usually boost interest rates in order to get inflation under control. But even though pocketbooks are getting hit hard right now, Powell is betting inflation will start to cool sometime next spring or summer, and thus a rate hike now would be premature.
We don't think it's time yet to raise interest rates. There is still ground to cover to reach maximum employment, both in terms of employment and in terms of participation.
Wall Street appeared to buy the Fed's game plan for now, with stocks rising to fresh record highs. The S&P 500 and the Nasdaq hit record highs for a fifth straight session on Wednesday as the Federal Reserve came through with an expected plan to start pulling back on the huge help it's been giving to the economy. The Dow closed at a record high as well, its fourth in a row. The S&P 500 rose 29 points, the Nasdaq jumped 161. The Fed announced it will reduce its bond buying program by $15 billion a month as the economy rebounds. It is keeping its eyes on soaring inflation, which Chairman Powell thinks will start to abate in the second or third quarter of next year. So for now, interest rates will remain near zero. Michael Gapin of Barclays says Wall Street gave a thumbs up to what it saw as the Fed's balanced approach.
So I think continuing to emphasize that, yes, inflation is high, but we still expect it to be transitory and to move lower, I think is a way to balance the overall message of we're tapering today. We've seen enough to start that process. It will, in general, remove monetary policy accommodation, but we're going to soften that with the view that we still think inflation is transitory and will be moving lower.
The Fed's decision came amid fresh signs of an economic pickup. Business activity in the vast U.S. services sector surged to a record high in October as an improving public health situation appeared to be boosting demand. The de-escalating health crisis also lifted employment. Private payrolls rose by 571,000 last month, according to a separate survey by payroll company ADP. Earnings season continued to give investor sentiment a lift. CVS Health beat quarterly sales and profit forecasts and raised its earnings outlook for the year. Shares touched a 5-year high. Marriott International also beat revenue and earnings targets. The hotel operator is benefiting from a rebound in leisure travel. That stock hit a record high. Moving the other way, Activision Blizzard. The stock dropped after the video game publisher behind Call of Duty and Candy Crush delayed 2 long-awaited titles, and its co-leader Jen O'Neill is stepping down after only 3 months sharing the top job. Shares tumbled 14%. A change in strategy at online real estate company Zillow sent the stock plunging on Wednesday. Zillow is exiting the business of flipping homes, a market it was expected to upend when it entered the segment 3 years ago. The company says the real estate market has become so volatile in recent months that it has made home prices quite difficult to forecast. Zillow went on to explain the decision this way. Home flipping has just become too risky, resulting in too much earnings and balance sheet volatility, adding, quote, "Our aim was to become a market maker, not a market risk taker." The original idea for the unit, called Zillow Offers, was to use the reams of data it had to make a quick buck by buying homes, making light repairs, and then quickly putting them back on the market. But rapid price fluctuations and a labor shortage that slowed down repairs and resales disrupted that strategy. Zillow says it will go back to just focusing on connecting buyers and sellers. One analyst called this a major strategic shift that raises questions about the company's future direction. Shares of Zillow plunged nearly 20% in midday Wednesday trading.